Hello and welcome to this special interview. The Indian economy finds itself at crossroads. Foreign institutional investors are worried whether this growth in India can be sustained. More so, there are short-term reasons for them to pull out their money. The technology sector to infrastructure, each going through transition. Everyone wants change and they're looking up to the policy makers. But is anyone listening? That's the focus of this special interview. And my guest today is Mr. K.V. Kamath. Welcome to the show. First question, every time you wake up in the morning, when you read the newspapers, they throw a lot of bad news at you. Whether it's a $1 billion fund getting out their $1 billion, whether it's another company that's got downgraded, a nation of ours that's seen a rate revision. What do you think this leaves you with when you look at these headlines?
You know, when I wake up and get to the newspapers and switch on the television, I'm reminded of what Mr. Wagul told me 16 years back when I just took over. Stop reading papers. Not so much the telly those days, but I don't do that. I break that first rule that he advised me on and then sit down and read. But the anchor I go back to is that my belief that we are in a period of change, rapid change, and that process is virtually irreversible unless we shoot ourselves not just in the foot, but we shoot ourselves in the head. I don't think we are doing that as yet.
Not as yet, but do you get a bit worried? I know you're a die-hard optimist, but when you do look at these headlines, which are actually real stories at the end of the day, they're not make-believe, do you feel that, even though we've not yet shot ourselves in the head and have in the foot, we need to do something to avoid that?
No, I think we will not shoot ourselves in the head. Whatever I have seen over the last 16 years clearly gives me confidence to say that we will not do. We may do things late, but we will set things right. A. B, I think what we are seeing, we could call it the drama that is happening around us, is what I would call the rise of governance in various forms. And the tugs and pressures that you see as governance falls into place is what we are seeing. And I think that ultimately that's good for the system. Right. So if there was something negative that was happening to the system, I would say, oh, we are heading down the path where we will shoot ourselves in the head. I don't think we are heading that way.
You don't think that we've opened up too much, whether it's, let's say, the spectrum pricing issue in telecom, whether it's too much of a hassle in terms of cancelling some of the licenses, whether it's the kind of visa issues we're facing on technology, whether it's about GAR, which is the tax avoidance treaty where we're putting some restrictions. Don't you think we've opened up too much, more than we can chew as a governance issue? Yeah,
you can look at it that way, but the way I would look at it is it had to be done once. It's better done now because we are changing gears very rapidly. To see the extent of the gear change, we must realize that 10 years back, this economy was not even at $500 per capita. From there, you are now gone to a country which is 1.6 trillion GDP. So, given our population, maybe $1,200, $1,300 per capita, set to double maybe in the next 5 years. Now, this sort of step change will not actually survive if we do not take the steps we are taking now.
Look at the double whammy we've had. We've had this whole GAR issue spill, with clarity, actually spill over and make it harder for FIs to look at India in the current scenario. And two, we had this S&P revision, where many would want to link it to the GAR matter, but there are several theories out there. So this sort of a double whammy at this juncture,
we don't need this at this juncture. And there is a third whammy, or I would put it as the first whammy. All this impacts mood.
Yeah.
See, what you then hear people talking, the media talking, there's this mood of negativity. And this mood of negativity then drives us. And basically our entrepreneurs have robust animal spirits. But when this sort of a mood of negativity hits them, they go into a shell. But having said that, my belief is that nobody can neglect an economy, whether it is going at 6%, 7% or 8%. Or 10%. Nobody can neglect this economy.
Sure, but I'm guessing we'll still be a big margin off when it comes to comparison with China. I want to ask you this, that as somebody who's non-stop discussing the Indian economy with foreign investors and domestic CEOs, do you think that mood of negativity has been now entrenched for far too long and there is no sign of it to come off?
A very good question, and I'll put it in perspective. In 2008, when there was a mood of negativity. And at that time, the onslaught of that mood was in the space of 6 weeks. End of August, there was no negativity. By end of September or middle October, complete negativity. But by March of the next year, the mood had lifted, because you could see that, what happening globally was not impacting us to the extent that we had thought. Markets were still soft, and then they started coming back. The entrepreneurial mood came back. This time around, you got all these governance issues which are getting addressed, but are not getting addressed at speed. So I guess that the mood will lift only when these start getting addressed. So I think it's a slightly longer wait this time.
So
possibly another 1 year.
For a change, sentiment is not perception, it's fact.
The sentiment is also fact, is clearly fact. It is not just perception this time. Right. There is perception, but then driven by certain facts. And to compound issues, you've got certain persistent problems that are coming up. Now, you look at last quarter's earnings numbers and this quarter's earnings numbers. This quarter a little early, maybe in another 15 days, we'll have a better idea. Last quarter wasn't too bad, really, and then you will see what the perception issue is. 22% growth in top line for, say, a sample of 2,500 companies is not bad. Net out inflation, still not bad. But when it comes to profit, you could see the pain starting to happen.
That's right.
And this quarter, I think you will see probably the same amount of pain, and I'll be very curious to see what is the top line growth. Early numbers, but for a very small set, about 200 companies, I think shows top line growth of around 17 or 18%. My own gut is it will end up being around 22%, the same as last quarter, and the profitability probably will remain the same. So now you got realism here. So it's not just perception. You got realism here, which is driving what makes up Indian entrepreneurs.
We've seen in April, it's become a turning point, even from a stock market point of view, where foreign institutional investors have turned the mood. They've actually become net, they've taken money out of the market this time, nearly 700 crores for April. And we saw this turning point within 3 days of the S&P announcement, which arguably people are saying is a bad one, and it's something that's highlighted or exposed India's policy-making inabilities, to the rest of the world. I mean, do you think that S&P might have reacted too soon?
Firstly, the negative outlook, I would not go too much by the negative outlook. And I think that the market reaction probably is not exactly related to that. It's more related to overall the other issues that we discussed. My only point with the rating process, the external rating process, is that for a very long period of time, we have been getting the thick end of the stick. We have been beaten up more than others. I don't think that we ought to be at BBB minus if China is at AA or AA minus. And China started the correction much earlier than us. And I don't think in any way China's problems are significantly lower than us. I'm not trying to compare China and India. We can do it another day. You then go to the developed economies. You've got countries there which are running double-digit deficits, which have no chance of growing at even positive territory, which are into recession. And yet you maintain the ratings there. Debt to GDP ratios are much higher. So sometimes it confuses me how outlooks are given and how ratings are given.
Do you think that they might have read more into the lack of conviction of the Indian government or policymakers to be able to give a rationale on how they're bringing the fiscal deficit down? Are they getting more worried about how the government is signaling about their own act?
Shailee, if that were so, then they should be more worried about countries which have fiscal deficits over 10% and with no growth. And whatever those governments say really cannot be bought, as it were.
But do you think that in some ways this did expose the fact that the world is watching India less for its consumption story now, but more for how its policymakers are handling this jewel in the crown, so to speak?
Very, very well put. I would think that no global business can afford to not look at India. So that will be the priority. Because a country which is showing signs of growing at whatever rate, as I said, between 6 and 10%, you cannot not look at. Because that is your bread and butter for the future and jam for the future. Having said that, then the second point that you made, the developments around. Again, if you are in business, you cannot not look at this. And I think investors and companies investing in India will carefully examine the pros and cons. And I would think that after that, the pros far outweigh the cons.